So if the total cost is $677, we're getting $450 a week rent, then the net cost before tax is $227. So it's this amount that we can claim on tax, and it's that amount that's called the negative gearing amount. So we can claim that on tax. You can either wait till the end of the year and claim it as a lump sum, or you can actually do it throughout the year or at the start of the financial year and get whatever tax you're due back every payday. So if we have a look at how much tax you would get back. So if that cost is $227, and if you're on the second top tax rate of 39%, which is everyone from $88,000 to $180,000, then you're paying 39% tax. So if you're in that tax rate, that's how much tax you get back for that amount of property cost. So if we go $227 times 39%, we get $85.53 back in tax every week or every payday. So if your payday is fortnightly or monthly, you get 2 lots of that or 4 and a bit lots of that per month. So now the property doesn't cost us $227 anymore because we're getting $85 tax back. The property is now costing us $141. And remember, we're still doing this at 5% interest rate. If we're at lower interest rates, it'll be a lot less. Now you can see here we say that's the cost before depreciation. So you can also claim the depreciation on tax if the property is less than 40 years old. If it's brand new, you can claim depreciation for 40 years. Now there's 2 parts of depreciation. One is the building depreciation. That's what's sometimes called the bricks and mortar, and that's the bit you get for 40 years. So to work out the depreciation, there's a basic rule of thumb. If we bought a $500,000 property, it's the building you can depreciate. So if roughly half the cost, $250, was for the building and the other half was for the land, it's the building we're depreciating. So if the total building cost was $250,000, normally the bricks and mortar part of the build is about 90% of the total build cost, 85 to 90%. So normally about $220,000. That's the bit we can claim over 40 years, and what you do get is 1/40th of that each and every year for 40 years if it's brand new. If the property is 10 years old, well then you get 30 years of that. If it's 20 years old, we've got 20 more years of that. And you can see 1/40th of $220,000 is $5,500. That's a pretty big tax deduction each and every year for the next 10, 20, 30 or 40 years. The other part of depreciation is what's known as the fixtures and fittings. The fixtures and fittings are those things like your curtains, carpets, blinds, air conditioning unit, hot water system, cabinets, all those sorts of things that don't last 40 years. Now there's a different age for each of those items, but on average it's about 15 years. So that quantity surveyor who does the depreciation report will estimate how long those things last and how much depreciation we can claim. But normally it's about $30,000 for fixtures and fittings on a $500,000 property if it's new. And we can claim that at roughly 20% per annum. So if we claim 20% of that in the first year, that's $6,000. And then we can claim 20% of what's left in the second year. So 20% of that, 30 minus 6 is 24,000. So with fixtures and fittings depreciation, it's what we call a sliding scale. You're getting less each year, more in the first few years. But in the first year, we get the addition of both of those amounts, the building depreciation, the bricks and mortar, and the fixtures and fittings. So if we add those up, we're getting $11,500 as a tax deduction just for depreciation. So remember, you're not having to pay that money out to get the tax deduction. It's what we call a paper loss. And we can claim that on tax. And if we claim $11,500 at your tax rate of 39%, we're getting nearly $4,500 per annum back in tax, or another $86 a week. So if we take that $86 tax saving, move it over here, remember it was costing us $141 after the negative gearing, tax deductions. Then we get $86 back for depreciation. Now the property is only costing $55 a week. And remember, we're doing this on 5% interest rates. If we did it on 4% or 4.5%, it's probably costing us zero or very little. So hopefully now you can understand cash flow and you can understand what it costs to own a basic property and then what it might cost if we find a property that gives us even better rent. And it's a really good way to understand property.